I'm sure almost all of your listeners have heard the following phrase somewhere in the Wall Street Journal or elsewhere. And the phrase starts, since 1926,
Hmm.
stocks have returned about 10%.
Today, we're going to do a little bit of myth busting. Is stocks for the long run always the safest bet? Today, we're speaking with financial historian Edward McQuarrie as he challenges decades of conventional wisdom on investing, diversification, and Roth conversions. Discover what investors often get wrong about the market's history and how a more realistic view of risk can lead to smarter, more resilient retirement planning. Ed was referred to us by Bill Bernstein, who joined us on episode number 510 of the podcast. I know so many of you truly enjoyed that interview. William said, if you enjoyed this, you're going to want to talk to Ed. And he is the professor emeritus at Santa Clara University. And after 3 decades of teaching in the marketing department, Ed retired from Santa Clara in 2016 to pursue research interests in the financial market history and retirement income planning realm. He received his PhD from the University of Cincinnati, go Bearcats, and he also has authored several books, and you'll see his research show up periodically in our Weekend Reading for Retirees email series. You've probably seen it in the Wall Street Journal, maybe Market Watch, or even Barron's for that matter. Today, I'm excited to have Ed here with us to not only discuss his research, but also why it's important to rethink risk, returns, and assumptions we build our retirements on. We'll also be discussing some maybe misconceptions around Roth conversion later in the show. You won't want to miss out on that, all in the vein to help you build a more grounded, resilient, and reality-based retirement plan. With that, let's get it started. Ed, welcome
All
to the
right.
show.
Delighted to be here, Casey.
Well, Ed, I'm excited to have another brilliant mind here on the show with us. And I understand now with most brilliant minds and most people like yourself that have been so deep in their work for so long, sometimes retirement can be a bit challenging. I understand you retired about 6 years ago, roughly, if I've got that right. So you've been retired
Not
for a few years. And I got to ask, do you consider yourself retired? Is Ed really retired?
Casey, I turned out to be a complete failure at retirement. Okay. Now, let me explain that a little bit. It's 2016. For a variety of complicated reasons, I'm bored with my professorial job. My younger spouse is still working and pulling in a good income. And, I didn't have to work anymore. We didn't need my salary anymore. And so I stopped. Okay, I was 63 at that time. And I thought, hey, what does the next chapter hold? So I experimented. I wrote a few blog posts. And, then after a couple months, honestly, Casey, my lifetime hours on the golf course is less than one. Okay. Uh, it turned out that the only thing I wanted to do, now that I could do anything I wanted to, was write papers and fiddle with spreadsheets. That's who I am. Okay. So I no longer describe myself as retired. I describe myself as on career number 2 or number 3 or whatever the count
Mm.
is there. I'm fortunate to be healthy, solvent. I can do whatever I want. And it turned out that what I want to do is pour myself a cup of coffee on Monday morning at 9 o'clock, walk into my lovely home office here and write and wrestle spreadsheets. That's
And and most of your research today is focused on the financial realm, but you're in marketing for what, about 30 years. But there's a lot of research and a lot of numbers that go into that space as well. So I imagine today did you make kind of that shift and focus to investing in finance out of kind of necessity too, or
let's see. So I had a subscription to the Wall Street Journal when I was 13. Okay, so there, if you will, there's a latent thread. We won't talk about the middle, 50 years or so, but there's a latent thread of financial interest. And curiously enough, it was Bill Bernstein that launched me on my current path. We didn't meet till a couple of years ago, but he started publishing his books in the early 2000s, and it was about that point that I looked at my 401, my 403b, my wife's 401k, and it was like, wow, hit 7 digits here. I think I better kind of study up on this
Mm,
and learn a little bit more about what do you do with all that money? Seemed like a big amount back 20 years ago, but
mm,
um, and so I started reading Bill's books. They were an eye opener. And I actually wrote some of my first financial planning articles back in 2007, 2008. Uh, I have a Barron's piece from way back then, thinking about a Roth 401k. Think again. That goes back there, a couple of Journal of Financial Planning, and then my marketing scholarship heated back up for a while, and then I retired, and then I got back to what I started to do.
Yeah, I'm curious. I have a marketing degree, but I also have a finance degree. And
Ooh.
I'm curious, how has your marketing experience and research on the marketing side, how does that influence your thoughts and the research in the financial side?
Not directly. I was a particular sort of marketing professor, if you will. For all intents and purposes, uh, I was a student of applied rhetoric. So that's very helpful in reading stuff that comes out of Wall Street or the financial stuff that makes its way into the popular press. Because uh, I have I have a great ear for jargon. I have a great ear for bait and switch. I have a good ear for that's why they put it in those terms. But the second sort of connection, you may have heard the old saw. Um, if youth only knew, if age only could. Okay. And with respect to that, so I'm kind of a funny beast because on the one hand, you know, I'm just 2 or 3 years into the financial work. I'm young within this discipline, but I have 30 years of scholarship behind me. I built a perfectly good scholarly career in the old discipline. So, kind of under the skin, I have a sense of, oh, yeah, uh, this is what a journal needs to see. This is, this is how research works, and I think that helps me.
I think we kind of talked about this when you first started, but I think that is so helpful because you're the kind of people that I want on the show.
Well, thank you.
I want those on the show that can recognize the BS, if you will, right? I don't want those on the show that are just trying to be self-promotional or they're trying to get something for themselves at the end of the day, they're trying to sell something. I want to have real researchers on the show, and
Cool.
you've cut through some of that with different researchers over time, and you've cut through some of that when it comes to probably different things that you've read or listened to, and you get to that very quickly. One of those areas you're most well known for, though, is Jeremy Siegel's work, who Jeremy's also been on the show, and you had challenged his stocks for the long run philosophy and some of that research. I'm curious. I mean, you have become most well known for this, I believe, amongst anything else. You do a lot of talks on this particular topic. So, why and when did you begin to question Jeremy Siegel's work in stocks for the long run?
I've always had an interest in history, financial and otherwise. I I probably encountered Siegel's book back there in the early 2000s for the first time, and um, I don't know. It's just one of those things, Casey. I just didn't believe it. Okay. It was too good to be true. And so idly, slowly at first, with more focus from about 2017, I thought, let's do a deep dive into Professor Siegel's sources. Okay. And I literally, and again, you got to be retired to do this kind of thing. Okay. But I literally went back and rebuilt the historical record of US stocks and bond returns from 1793 forward. Okay. Now, yeah, I'm walking down my neighborhood chatting with friends, and people say, stocks and bonds traded in 1793? And my response is, yep, yes, they did. Okay. Siegel's contribution initially, remember the first edition of his book goes back to 1994. Um, uh, uh, up until that point, if you said financial history, if you said, let's go back in time on stock and bond returns, you worked with the stocks, bonds, bills, and inflation yearbook that Roger Ibbotson started publishing in the early 1980s. If any of your listeners, I'm sure almost all of your listeners have heard the following phrase somewhere in the Wall Street Journal or elsewhere. And the phrase starts, since 1926,
Mm,
stocks have returned about 10%. Okay. Well, you know, I'm sitting back there years ago asking myself, well, what happened in 1926? Is that when the New York Stock Exchange opened? No. Is that when some important newspaper of record started publishing so historians could get good data? No, that was 1865. So why 1926? Well, Ibbotson's predecessors, Fisher and Laurie at the University of Chicago, they had a grant from Merrill Lynch to take the data back as far as they could from their 1964 start. And they ran out of money around 1926. That's why the record stops there.
hmm,
And, as I got further into the history, I realized that literally 1926 is no kind of dividing line whatsoever. The history is continuous. The publication that Fisher and Laurie used to get their initial stock and returns, it goes back to 1865, and turns out the data record goes back again to the 1790s.
hmm. Yeah, I love that you're doing this research because I've had much the same sense and some of the same frustration. I had a guest on one time that said, "Well, you just put it in stocks because they always go up," and we didn't air that conversation, and because I said the reality is, I mean, look at you can see extended periods of time that many don't recognize where you could have negative or zero returns. I mean, we had it pretty recently. We had the lost decade, right? You could go through a decade, you could go through 20 years when you don't have positive returns and equities, but that's not discussed. Now, I still believe in stocks for the long term. It's just defining what is stocks for the long term. How long is long term? And I think most people seem to have the idea of long term of, 5 to 10 years. Some might say 30, 40, 50 years even. And I think some have heard some of your research and they've come to the conclusion that, well, Ed just doesn't like stocks. Ed's bearish on stocks over the long term. Yeah, I guess there's multiple questions in there, and I'll leave it up to you to see where you want to take it.
Okay, let's go back to basics here. Okay. It's not necessarily true, but most people would nod their head to the statement stocks are riskier than bonds. Okay, well, that sounds like common sense. Everybody knows that. Then here's the next crucial leg of the argument. Because stocks are riskier than bonds, no rational person would take on that extra risk without the prospect of some extra return.
Mm,
And therefore, the theoretical expectation is that because stocks are riskier, then they must offer a higher return for rational investors to bother choosing them. And then here's where the argument slips a gear. Okay. Um, because stocks are riskier, they outperform bonds. And in Siegel's telling, stocks just about always outperform bonds, which causes me to ask, well, then stocks aren't very risky in the long term, are they? And if stocks aren't risky
mm,
in the long term, why should they outperform in the long term?
mm,
Return is a reward for assuming risk. If there's no risk over 20 years, why should there be outperformance?
mm. That's an interesting take. That's an interesting take. Now, when you look at these past periods, and you look at several historical periods where stocks have underperformed bonds for extended periods of time, what are some of the key factors that led to that underperformance?
Okay. Uh, One way to approach that question will be to, remind people of Siegel's sources. And again, everybody, myself included, as well as Siegel, uses the Stocks, Bonds, Bills, Inflation Yearbook, I'll call it SBBI here, for stock and bond returns back to 1926. And Siegel and myself mostly use Robert Shiller's returns, his spreadsheets on the web, back to 1871. And Schiller was working off of a book by Alfred Cowles, published in 1939. Cowles was really the first historian of total return, price appreciation plus dividend reinvestment. And so until I came along, in many ways, the horizon was 1871. Okay. Now, you know that Siegel's book has a chart that goes back to 1802. So, what was Siegel working off of when he went back behind 1871? Well, for the most part, initially, he was working off the book by Smith and Cole, published in 1935, an index of 7 bank stocks, later railroad stocks, back to 1802. Now, I'll tickle your listeners' fancy with a little story about how Smith and Cole picked those 7 stocks. You see, they were cycle theorists. Okay, they were interested in stock prices as a leading indicator of the business cycle, but they had a pre-modern understanding of statistics. So what they did, they collected price returns on literally dozens of stocks, the same ones that are in my new database. But they made a price chart for each one on a transparency. They stacked the transparencies on a light table, and one by one, they threw away every stock that behaved idiosyncratically. Like, for instance, the stock that went around da 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 and then plunged to zero. That stood out on the stack of transparencies. They threw that one away.
Mhm,
Can we say survivorship bias? Okay.
mhm,
And so basically, they took the 2 or 3 dozen stocks that did trade in the early 1800s, and they got rid of every one except the 7 that behaved similarly. And that was the index that Jeremy Siegel used in his early editions for those returns in the 1900s. And it proved to be rife with survivorship bias. They left out all the bad stuff. The stocks that went down stood out there in that light table and they threw them away. And,
mhm,
it wasn't until I came along, and more about that in a moment. I had resources available to me that Siegel did not. But it Siegel himself, he's a chaired professor emeritus at Wharton. He made no mistake. He just had lousy sources.
mhm. So I'm just going to go back to basics. Do stocks outperform bonds over the long term?
Sometimes yes, sometimes no.
And is there a period of time where you do find, hey, if you're going to invest in stocks for long-term outperformance over bonds, that you need to be invested in those equities for 20 years, 30? Is there a time frame that
No,
you believe?
it's always sometimes yes, sometimes no.
And how long have been some of these periods throughout history where you've seen stocks underperform bonds?
100 years.
100 years. And what would that time frame be?
United States, 1800 to 1899.
Uh, 1800 to 1899. I mean, some of this research that you've conducted, and I've seen it conducted in the past, some of this research takes us all the way back to the 1700s. And when you look at periods of time like that, I mean, we're sitting here almost 300 years later, 200 years later, plus than the 18 and then 1800. How relevant are those time frames to where we find ourselves today?
That's probably one of the questions I get most often, Casey, and I bet it was on the lips of at least half your listeners at this point. And I have a particular protocol that I use to answer that question. Relevance. All right. Well, yeah, no, relevance. Of course, we want relevance. So really, all the returns before ChatGPT was released late 2022, those metal benders, those box software companies, none of that's relevant to the AI age. You can't use any of that historical data, right?
Mm. But
I
can
mean,
you?
before 2022, I mean, my God, it's ancient history, man.
Yeah. So you feel that all of these timeframes have some relevance to today, but I think this goes to your thoughts around economic regimes and how investment returns over different timeframes are heavily influenced by these different economic regimes. And so what I want to know, well, how do you look at the economic regime we're in today? How do you define economic regime, and are there different types?
Okay. So, regimes, which I do find in the multi-century data, are a longish period of time where a statement like, quote, dividends have accounted for 40% of the stock market's total return, end quote, where those statements hold true, but also, when viewed in a longer term, the truth of that statement proves to be bounded in time. Okay, so that's one example of a regime. Another example of a regime is when stocks and bonds are negatively correlated. Okay, I can show you charts where that correlation over the 2 centuries is sometimes negative, sometimes positive, and where beginning about the 20th century, it started to gyrate in a much wilder, set of oscillations than before. So I wandered a little bit in my answer to your question, Casey. You better take me back a little bit.
Mhm. No, I'm stuck on thinking through these different time frames. You look over these really long time frames and you say it's all relevant. This is all relevant when we look at stock and bonds returns over long periods of time. I don't think you're saying this is relevant to what we can expect moving forward. And the takeaway isn't necessarily that stocks don't work over the long term. The takeaway is that it you have to be careful on which data is cherry picked in order to determine if stocks and bonds are going to perform better or worse over a long period of time. And ultimately, you have to make decisions that keep you diversified because stocks aren't always going to go up, bonds aren't always going to go up. And you need to be very careful on the inputs and assumptions you're making in your planning.
I think that makes a lot of sense. Let me try to take this discussion about stocks for the long run up a notch. Okay. In my personal opinion, stocks are a good wager for your surplus funds that you won't need for decades. They are a good bet. Okay. Uh, Although it's true that sometimes, yes, stocks outperform and sometimes no. And sometimes stocks have a positive return over decades and in real terms, sometimes no. It has been true, particularly over the last 100 years, that stocks have been a very good bet. Okay. So part of my message to your listeners is that, if you're going to be a stock investor, more power to you. Understand that you are placing a bet. You are making a wager. And with any wager, you can win or you can lose.
hmm Yeah, before I think this will take us pretty quickly into kind of retirement income strategy. But before we get there, there's another thing that you have focused on in the past, and that is historical data always getting revised down. And I wanted to bring us to that piece. Historical data always gets revised down, and I wanted to bring that up today because when I look at what's happened over the last decade, and you mentioned the name Shiller earlier. From about 2015, 2016, people started pointing to Shiller's valuation measure, PE 10, and saying, hey, stocks are overvalued. We're going to see lower long term performance over an extended period of time. And yet, we've seen much higher returns than were expected year after year as far as average rates return go over the last decade. And now we're seeing Shiller's PE 10, the highest it's been in over 25 years. I looked at it this morning. It was a little over 38 on PE 10 today. And we have the estimates for long-term returns. They just keep going down, you know, but but it seems like that's not happening, where they're not revising down those expected returns over the last decade. They keep getting revised up. Can we expect what can we expect that to continue to happen in the future? It doesn't seem like this always getting revised down is coming to fruition during this economic regime, if you will.
You just haven't been patient enough, Casey. Okay. Um, no, I mean, of course, that's an all-purpose catch. The old joke, the old joke on Wall Street was, in your forecasting, never be specific about both amount and time frame. Okay. That's very dangerous, as you've just described. Okay.
Mm,
If you took the Shiller research and said, all right, we have a high price earnings ratio, therefore stocks, are going to kind of mean revert here. It's very important not to put a time frame on that because, that's where you get hosed. And again, coming back to the relevance question, uh, it doesn't matter whether it's the last 5 years or the last 100 years. Uh, you know, there's no extrapolation. Okay, the future is unknown. Okay, or as Yogi Berra liked to say, prediction is difficult, especially the future. And so, the you know unfortunately, and here the old Upton Sinclair line comes to mind, uh, and I'm addressing any of the investment advisors in your audience. Uh, it's difficult to make a man understand something if his job depends on his not understanding it. Okay.
mhm,
Clients are out there. They want a prediction of what the stock market will do. They don't want to make wagers. They want sure things. Okay. And so there's always an enormous urge within the industry to say, well, look, the Shiller CAPE, that's our best predictive tool. And it says stocks are too high. Then it goes up again. Stocks are too high. And then it goes up again. Now, there's another famous fellow that some of your listeners will recognize, the economist from the 1920s, Irving Fisher. Irving Fisher lives in infamy because in 1929, he said, stocks have reached a permanently high plateau. Okay.
mhm.
Yeah, no, worst timing of a forecast ever. You have a lot of Siegel adherents today. Anytime my stuff appears in the Wall Street Journal, somewhere in the comments, there will be questions like, stop the fear mongering and buy some more stocks. Uh, it's like there's people out there, Casey, today, right here in 2025, who are convinced that stock returns have reached a permanently high plateau. There's never going to be another bear market. Never. No. AI is just going to take us to whole new levels.
Mhm.
And that's really the virtue of reading a couple of centuries of history, and particularly the international history that we haven't brought in yet. Oh my, you know, sometimes it's been good, sometimes it's been lousy,
Mhm.
sometimes it's been absolutely horrific.
I think some could hear this, and it is easy to just go, yeah, I'm just not going to listen to him because that's just overwhelming. My whole retirement strategy just blew up, right? I
Yeah,
mean,
yeah, yeah. Uncomfortable. My
yeah.
God.
Yeah, I
Y-
mean, if you just rewind the clock, I don't know, 15, 20 years ago, I mean, almost everybody was following the 4% rule, a systematic withdrawal approach. They'd, carry, say, a 60/40 portfolio, just take systematic withdrawals. And then it started evolving where more and more people today are using a bucket approach, and they're carrying some cash for maybe 12 months. I think it was Bill Bernstein said he has a tip bond portfolio for the first 5 years, and then everything else is equities, right? So he's buying himself 5 years worth of time, and it's like that. Does the bucket strategy fall apart here if you say, hey, I'm going to keep cash for a year, I'm going to keep bonds for 10 years, and then I'm going to have equities for everything after 10 years? But now Ed's telling me, well, my sometimes yes, sometimes no. Now my equities might go significantly down in value over the next 10 years. My strategy no longer works. How do you help people through that?
First of all, the strategy that Bill has articulated, we'll delve into that a little bit more. We'll throw a Nobel Prize winning name at it and develop it conceptually. It's not at all a bad strategy. All McQuarrie is telling you is it's still a wager. Okay,
Mhm.
you retired in Japan in 1989. Where are your equities 10 years later?
Mhm.
Oh, it isn't very pretty. Okay.
Mhm.
So there's no guarantees in this world. Hey, maybe some administration could come to Washington and start fiddling with the consumer price index. What's that going to do to your tips? Okay.
Mhm.
You know, the two words that just make me laugh in any financial conversation are, when joined together, risk free.
Mhm. Mhm.
No, nothing under heaven is risk free.
There's always going to be some degree of risk, even if that's inflation risk. And, I think that takes us to one of our weekend reading subscribers' questions. So we send an email out every Friday. Those subscribers are invited to drop questions into the interview here with me.
Ooh.
And we have one today that I thought was it just fit really well into the conversations from John. It's pretty specific about his retirement strategy, but I think it leads us into a pretty potentially interesting discussion. John said, I'm retiring at 65 in 3 years and will have income from my ESOP to get me to 70, where I'll start Social Security. At that point, I'll need an additional $30,000 a year to handle my base living expenses with a portfolio of stocks to generate legacy, travel, and charitable gifts. I plan on building a MIGA ladder, a multi-year guaranteed annuity ladder that is fixed annuities, consisting of five-year fixed annuities, each at $120,000, and currently offering 6.25% annual fixed rates. Can I get similar or better results with bonds? He says, in the past 15 years, I've been disappointed in bonds. The way that I think about this question is that I think your research may have some rethinking using solely stocks and bonds as a retirement income solution altogether. Is that a rational conclusion to say, well, if we question stock and bond returns over the next 20 years even, and we can't the degree of predictability we have is not as much as I thought there was, then maybe I need to incorporate other tools. Maybe I need to incorporate a MIGA like John is considering, or some type of annuity product, maybe real estate for that matter. I don't know. Is that a rational conclusion for some to rethink using solely stocks and bonds as a retirement income solution altogether?
All right. So here we do have to go back to the conceptual ground to give a good answer to John's question. A theorist named James Tobin was active in the late 50s and early 60s. A few of your listeners may recognize his contribution as the separability or the two-fund theorem. And again, it's going to be the conceptual background to the all bucket strategies. And basically, Tobin's insight was, look, there's a certain amount of money you need that you can't take risk with. You need the risk. You need this money not to be at risk.
You
It's
mean
got
risk
to.
free? You mean risk free?
Yeah, as close to risk free as under heaven permits. So, but once you have, in John's case, locked in your expenses 65 to 70 with some minimum risk asset, and potentially once he has locked in that 30,000 a year after age 70, out until whatever life expectancy he would like to use. Uh, Once you have done that with minimum risk instruments, everything else should be in the risk portfolio, which is stocks. So the notion is, um, you know, John doesn't have to go to Paris. John doesn't have to leave his ungrateful kids a million apiece. Okay. John needs to be able to eat, have shelter, and, kind of live his life in the manner to which his life station under late capitalism had made him accustomed. And for those purposes, you don't want bond funds. I, Casey, I hate bond funds. I got rid of all my bond funds a couple years ago. What John needs, whether it's MIGA or other sorts of stable value funds, what John needs is a tips ladder. Okay, um, that MIGA interest rate of 6.25 didn't feel so good in mid 2021 when inflation hit 9%. Okay, so I'm covering a lot of ground here, but let me just kind of summarize and hand the microphone back to you. The bucket approach is very rational. And the part of the bucket that isn't in minimum risk, locked in, laddered income products, it should be in stocks. That's what I would do.
Yeah, and you said even tips come with risk. There, as you laid out, there's interest rate risk or really inflation risk, say with annuities for that matter. And so it does make sense for that, baseline income you can't live without. Maybe it's not all annuity income, maybe part of it's annuity income, maybe part of it's tips, but it feels like we're getting closer to coming to the conclusion that it does make more sense to have a more diversified approach to your retirement income strategy than just simply leveraging stocks and bonds.
Okay, let me be kind of cantankerous here and argue with that quite sensible conclusion that you just offered. Now, it's not about diversification, except within the risk piece. Within the risk piece, you want to be perfectly diversified, which is to own the total market at the lowest possible cost. It's not about diversification, it's about separation, separating out the minimum risk portfolio from the risk portfolio. And
Mhm.
this has probably come up elsewhere on the podcast, but target date funds, in my view, as done by, say, Vanguard, are great up until your 50s. They're
Mhm.
great up until retirement begins to approach. And if you don't have an advisor and you are not steely of spine with a cast iron stomach, they're good for the ordinary person too. The problem for the do it yourself investor who's approaching retirement with 1,200,000 or 5, okay, the middle class person that did well, okay. The problem is that the target date 2035 fund, it's diversified, but you can't separate out the minimum risk piece when you would need it. And the total bond piece, which is the minimum risk piece within those target date funds, um, you know, uh, people dreamed a dream from 1982 to about 2022 that total bond, short, medium, long, government, corporate, the whole kitchen sink. What could go wrong? And then 2022 happened.
Mhm.
Okay. So again, it's not about diversification, it's about separability. All the diversification you need in the risk side comes with the total stock market portfolio. It's separating out the minimum risk so that, you're a Japanese retiree, it's 1994, stocks keep going down, you know, you can hold on for the long term because all your necessities were in separable, minimum risk investments.
Mhm. Yeah, fixed income, which I mean, like you said, since 2022,
It's not
interest rates
it's not fixed if it's in a bond fund.
fund. Yeah.
It's
Well,
only
on that note, what are your feelings over target maturity bond funds?
okay. So I want a little expansion. What is a target maturity bond fund?
So we have a 10-year bond fund and it's closed, right? Once all these bonds are purchased, it's going to be liquidated in 10 years. So
Mhm.
there's nothing exchanged during that period of time.
Okay, good. So, that is a way to have a 10-year term certain very similar to a MIGA. In fact, that would be the competition, except you can't typically buy 10-year MIGAs.
Mm.
And so you do have the certainty, sort of paid as agreed.
People are doing that to reduce their interest rate risk, right?
Yeah, yeah,
Some
and
say
again,
eliminate.
and in my response there is always, why not buy a 10-year TIPS and eliminate your interest rate risk and your inflation risk?
Hmm. Yeah.
S and not pay even the 10, 15, 20, or 25 basis points that the target date maturity bond fund has to ask in order for
Hmm.
it to be worth the time of anyone to provide.
I can hear some that are like, it's great that Ed figured all this out. He went out, he did all the research, he dug into everything, and he has 100% confidence that he knows what he's going to do with his retirement plan. But you know what? I don't have that amount of time. I don't want to do that kind of research. Heck, I'm not as smart as Ed. I don't want to do this. How can the average retiree recognize? I guess the question is, how can they recognize the truth when they're either doing their own research or building their financial plan or working with a planner that's building a financial plan for them? How can they get the level of confidence that you clearly have?
Well, you know, I've never been asked that question before, Casey. And, I'm not sure I'm going to have a good answer for you. So let me flail around a little bit and make the attempt. Um, you can be certain that stocks are risky. You can be certain that they're a wager, and you can be certain that they have been often a good wager. Okay, particularly for the patient and particularly for funds in surplus. Second, you know that a ladder of tips, bonds, out as far as you want to lock down your bucket, you know that that is the minimum risk security, at least as long as you're a resident of the world hegemon here, the United States at the moment. Uh, Now, I always have a footnote after saying the things I just said, and the footnote reads something like, absent nuclear holocaust, AI apocalypse, and other equivalents in which the game board is thrown on the floor. Okay. Yeah. So tips are the minimum risk portfolio, but it won't help us if the North Koreans drop the big ones. Okay. So, you can know for sure, or at least I hope you will take my word for it, that stocks are risky and tips ladders are as minimally risky as you can be. There, I spelled it out in two recommendations.
I feel like I'm already going to know the answer to this, but I know the listener wants to know. And could you, from a high level, tell us what your asset allocation mix is in your retirement portfolio on a percentage basis? What's allocated to cash? What's allocated to tips? Please.
All right. So keep in mind that I turned 72 this year. So it's not retirement planning for me, Casey. It's retirement doing. RMDs start next year. And what do I have roughly? Well, I I didn't know as much in 2016 when I retired. I was taken at that point with the notion that it had become more important to secure the return of capital rather than the return on capital. And so I probably went too conservative by my present lights. I think I started my retirement. Again, my wife was still working. That eases many a squeeze. I started my retirement probably about 30 stocks, 70 bonds.
Hmm.
Okay. And, gradually I did more of this research. And then, very importantly, you know, the bond market suffered the worst bond market ever in 2022. And I've got the historical data to back up that claim. Okay. Worst bond market ever. And at the same time, all of a sudden, tips began to offer a positive yield and then a good yield. And, today on a 25 to 30-year tip, this is yesterday's numbers, but 2.6% real. Now, here again, it helps to have my learning and research as a background. I know what the average real return on government bonds has been since 1900. Elroy Dimson tells us so in his yearbook. The average real return on long bonds since 1900 has barely been 2%. Actually, that was before 2022. Now it's 1.7. So you can get 2.6 on a TIPS today and 2 plus over the past couple of years. So now, again, it's hard to get the denominator. I'm not going to tell you how many millions I have, but let's just say that out of the total, I probably have 12, 15% of my retirement portfolio in long tips. I've got, I was an academic, so I have access to the turbocharged stable value fund known as TIAA traditional. I'll be annuitizing those funds to cover my RMDs from that account. I probably got another 20, 25% in that stable value fund, if you will. And let's see, everything else, it's all stocks,
Yeah.
variety of
So
different index stock funds.
as you break that down, it's about 40-60, about 15% tips, 25% stable fund being annuitized, and 60% equities. And I,
Yeah, but oh no, no, I left out. Oh God, if anyone from the Bogleheads forum
yeah,
is listening to
20%
this,
in Bitcoin. No.
well, no, 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 no. Oh, that I, this episode might not be aired in that case. No, I forgot about the, what is it now? I forgot about the 15% in permanent life insurance cash value products. So
Okay.
it's really, it's a little under 50% of equities now, but that'll probably increase, as the stable value funds get annuitized, they
Yeah,
turn into income and drop out of the portfolio.
I love that. Yeah, they have, I mean, essentially it's 15% tips or bonds, fixed income. I know you don't like that term. So you have 15% in tips, 25% stable value being annuitized, 45% equities, 15% permanent life insurance. I think that's really enlightening for so many. And we could probably stay on that for a while. I just don't want to miss out on the Roth conversion discussion. And I
All right,
know
yeah, no,
that eventually we will run out of time. And because I think your views on Roth conversion are really helpful for so many. So let's go there. You mentioned in your research that your views on Roth conversions, they've evolved specifically over the last few years. How have your views on Roth conversions evolved?
okay. So let's go back to 2021. I've just finished my magnum opus, if you will, the paper that will eventually be published in the Financial Analyst Journal and make my reputation as a financial historian. I haven't submitted it yet. It needs to just sit there. Okay. That project has occupied me for almost 3.5 years at that point. I need something else to do. So a family member was retired, was interested in the Roth conversion question. Should she not? And it looked like a nice opportunity to uh, um, play around with spreadsheets. And so I had some fun with it initially. I would say that my initial write up was fairly sort of, I believe the technical term is May, MEH, fairly May about the prospects of Roth conversions, and that was kind of fun as a sort of proof of concept to show that based on the law of compound interest, that if you did live long enough, 105, 115, uh, your conversion had to pay off. Okay, because just that little bit of tax drag, compounding and compounding and compounding and compounding, would eventually even make a conversion at parity, convert at 24% to withdraw at 24%, would still make it profitable. But then, and here's what I want to talk about today. Then I took it to the next level. My current piece is in the journal Financial Planning last September, and it is called
Smart
in
Roth.
net present value analysis of Roth conversions. Okay. And let's see, how can I introduce the point? Um, uh, the truism that you will read in any journalistic article, quote, you should probably consider Roth conversions if you anticipate your tax rate in retirement will be higher than your tax rate while working. Okay. Now, that was never true for me. Okay. And the reason it was never true for me is I was a dual income professional couple in California. And under the AMT phase out, my tax rate while working was 44.3%. It sure ain't that high now while I'm retired. But you will see people on discussion forums, and they'll say things like, yeah, I'm in the 22% tax bracket now, and I'm afraid the Trump tax cuts are going to expire after 2025, and my bracket is going to go up to the 25% bracket, and that 3% gap is going to apply RMD after RMD, and I am motivated to do a Roth conversion. So here's the paper in a nutshell. Yes, if you convert at 22, and all your RMDs for the rest of your life are taxed at 25%. And if you convert $100,000 here at 22%, you can anticipate a profit of $3,000 on that $100,000 conversion. But you will book that profit RMD by RMD year after year after year. And you will probably not have booked any of the $3,000 profit during your life expectancy. Your heirs, provided they also are in exactly the anticipated future tax bracket. Because come on, Casey, how hard is it to predict tax rates 30 years into the future? You can do that. Any podcaster can do that. Really?
And does that research take into consideration potential IRMAA penalties as well as Social Security taxes?
I have another paper
Of
on,
course you do.
sorry, couldn't resist. This one is titled IRMAA, Resistance is Futile. Okay. And what I did there was you do see this in discussion forums. You see people saying, well, not only am I going to be in the 24% bracket or 28% after the tax cut expires, not only am I going to be in the 24% bracket, but I'm going to be in IRMAA too. And so I'm going to convert now, even if I have to pay an IRMAA, to forestall those future IRMAs. And what I found in that paper was uh, you, you could never get ahead. If you paid one IRMAA now, you might be able to save one IRMAA for 1 year, but you never got to the point where you could save two IRMAs now and save 12 years worth of IRMAA later. We don't have time for me to explain that math, but basically, sure, if you can convert without IRMAA today at 12%, and you anticipate once those RMDs from your awesome tax deferred accounts start clicking in, that you will be in the 24% bracket, plus the equivalent of 4 percentage points on IRMAA. Convert at 12 to save 28. You'll start booking a profit. You'll make a profit net within, I'd say, 12 to 15 years.
Mhm. I mean, ultimately, this is just a math equation, right? I mean, you just need to run the numbers.
Well, that's how people treat it. We know the future tax rate. We have perfect clairvoyance to the future tax rate. Because what I do in the Roth conversion paper is I say, well, what if you didn't have perfect clairvoyance? What if Congress messed you up? Okay. What if Congress cut your taxes? What if
Yeah.
you screwed up your personal financial forecast? What if you forgot that the tax bracket boundary goes up with inflation each year and what 10 years of 3% inflation will do? What if you converted at 22 to avoid 25% and found yourself in the 12% bracket? Well, then you would start booking losses on that Roth conversion year by year by year until
Mhm.
Congress changed its mind again.
It seems like most of the numbers and in your research, you say, hey, maybe, let's just say maybe we run the numbers and you look over 20, 30 years and, eh, you know, you didn't save much. It was minimal. Maybe it was a few thousand bucks that I saved by doing these Roth conversions. Maybe it was a little negative. Maybe it didn't really work out. Maybe I lost a few thousand bucks by doing this conversion. But aren't there some psychological benefits that also should be counted into this, that now I've at least eliminated another variable in my planning. I don't have to worry about taxes going back to the way they used to be.
No, 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 you have not eliminated that variable at all. Every Roth conversion is hostage to unknown future tax rates until distribution is completed, i.e., 10 years after your death. Okay. Now, if you're going to convert today so that 3 years from now you can empty your Roth fund and buy a Porsche, well then you're going to get those thousands of dollars in just a few years. But if you did the Roth conversion to reduce taxes on future RMDs, this is going to play out over your lifetime plus 10 years. And that's a long, long, long time. Now,
Mhm.
to your point though, Casey, there is what I like to call virtue signaling in Roth conversions. Okay. It is virtuous to run the numbers, find the positive return, suck it up, and write that $24,000 check to the government, a check you didn't have to write this year, a check that hurts you a little bit to write. I don't know about you, but I hate to write large checks to the government that the government didn't ask for right now. Okay. So there's virtue signaling with Roth conversions. That's the psychological piece. You are a smart cookie. You ran the numbers. You, forgetting the fact that you're not clairvoyant, have eliminated a variable from the equation. And you can say to everyone, it wasn't easy. I didn't like writing that $24,000 check, but I gulped and did it because it was the right thing to do.
Mhm. In your writing, you say that doing a conversion is like giving the government a long-term zero interest loan. I want to talk about that a little bit. And but it isn't that better than making deductible contributions or leaving assets in a traditional IRA for that matter and holding a long-term variable rate loan with the government? Don't you create some certainty?
Um, Last time I looked, adjustable mortgage rates were generally lower than fixed mortgage rates. So yeah, you can create the near certainty that you overpaid your taxes.
Yeah. Yeah. And you look back at those that had adjustable rate mortgages that they purchased, you know, several years ago, they're not real happy with where they
That's right.
stand today.
That's right.
Yeah, they would have been happier if they would have locked in a fixed rate to create more predictability about the future.
And the counterexample is the person who did the
Isn't
Roth
this just
conversion.
the whole sometimes yes, sometimes no?
The
Is this
counterexample,
not any different than your stock conversation?
yeah, the similarity is growing on me, Casey. But my point here is Roth conversions became possible in 1998. If you have income in the 22% bracket today, you paid 28% on that equivalent income in 1998. Okay. So the person that grabbed that first Roth conversion opportunity to eliminate uncertainty about future taxes instead saw
Sure.
their tax rate drop from 28 to 25% in 2003 and then 22% in 2017.
Mhm.
Nobody knows the future.
There we go. There is a common thread in all of your research, Ed, and I can see exactly what it is. So we wrapped up the last bit on knowing what your kind of portfolio allocation is. So, Ed, you doing any Roth conversions?
Uh, uh, my final proof that I walk the talk and I eat my own cooking is I have never done a Roth conversion.
Oh, now does someone could listen to this and say Ed hates Roth conversions, but that usually I feel like you end most of these papers with I don't hate Roth conversions. So let us, is it known? Do you hate Roth conversions or not?
Um, the over at Advisor Perspectives, you can find a piece that Bill and I wrote entitled "Smart Roth,
Dumb
Dumb
Roth.
Roth."
Yeah.
Okay, I love Roth accounts. I have never done a Roth conversion, but I do have, let's see, of that equity portion, I've got 10 to 15% in Roth accounts. You know how I got those Roth accounts? Backdoor
After
Roth
tax.
conversions. I don't really
Okay.
call those Roth conversions. You know,
Mm.
you convert 1 second after the non-deductible IRA contribution. That's not what I call a conversion. So, uh, if I was poor enough to have a deductible IRA contribution, as I was I always made traditional 401k contributions. So again, Roth accounts are beautiful. Let me give you a second example. I have a family member. I'll call her my niece, even though she's my second cousin twice removed. She's young. She's in Silicon Valley. Do you know what they pay data scientists in Silicon Valley today? Salary, bonus, stock awards. She's 26 years old making $300,000 a year. Okay. You know what I advised her to do? Well, first, since withdrawals could be 80 years away, she is 100% in stocks. Okay. Second, she maxed out her traditional 401k contribution, all 23,500, because bless her heart, she's in the 44% tax bracket too. And then, like so many Silicon Valley companies, her plan allows instantaneous mega backdoor Roth contributions. So the next $47,000 of contributions is all going into her Roth 401k because she exhausted her deductible opportunity first. No, Casey, don't get me wrong. I love Roth accounts. I just won't do an overly expensive, uncertain, could win, could lose Roth conversion.
Mm. Well, Ed, I love your research. I always love reading your papers. I think it's always thought provoking. And I'd love to know what's next on the docket. What do you have your eye on? What's the next target?
Let's see, what am I working on now? What am I? Oh, Bill and I are going to maybe write a book.
Okay.
And the book is titled something like How Much You Must Save for Retirement. Hard truths, straight talk, tough love.
Well, pretty sure we're going to have you back on for that one, and so so
Thank you,
I'm
Casey.
really excited about that. But let's close it out. You're on the Retire with Purpose podcast, so I have to ask, what does that term mean to you? What does retire with purpose mean to Ed?
Um, Not retiring in my traditional dad's way, who played golf and then played solitaire and then died. Okay. So, uh, I'm writing articles and papers. That's what gives me purpose.
I love it. Well, I hope you keep doing it because I think central to that, I think what retire with purpose really means is elevating the lives of others, creating meaning in the world, creates meaning for yourself, and that's what you're doing. So, Ed, thank you for your research. Thank you for all of the work, and thanks for coming on the show.
Thank you, Casey.